It is sunny and warm today in the city of Toronto. What a nice thing to finally be able to say after a long winter and spring. It is Friday, May 22nd, and welcome once again to your Guide Through the Storm. I am Bob Simpson, your host for this series of webinars. Thanks for joining us today, the 9th in our webinar series. And thanks to those of you who have shared your appreciation for these webinars and have recommended the webinar to friends and colleagues. We have a lot to cover today, so let's jump right in. We have a number of new participants on today's call. Our panelists again today are Paul Tyers, Managing Director at Wealth Stewards, and myself, Bob Simpson. But we have a number of new participants who are joining us who may not be totally familiar with Wealth Stewards. So I'm going to turn over to Paul for a sec, just to introduce the firm.
Thank you, Bob. And as you said, it's really enjoyable having a nice day like this. And let's hope it carries on for the weekend. We have a number of people that have joined us from a few of the accounting firms that we work closely with. So we want to welcome you. And just as a very brief introduction of Wealth Stewards, you can see our website in front of you. And in short, we are financial planners and portfolio managers. And most of what you're going to hear today is on the portfolio management side. We hope you enjoy today's session and get some value from it. And if indeed you do, you're going to receive a follow-up email. And we hope you visit our website, and you see right in the middle there, it says schedule an initial assessment. And we welcome people to do that. That's a complimentary service. To just see if you might be a good fit for our firm and we might be able to assist you. So thank you for joining us, and we'll carry on from here.
So one of the things that we do is we record all of these sessions and we post them on the portfoliostewards.ca website. So if you were to navigate to portfoliostewards.ca, you'll see right on the home page, if you're looking for a guide through the storm, click here and you can pick up all the recordings that are there. If you have a question, right down at the bottom of your panel, there's a Q&A button. If there's something you want to ask Paul or myself, just click the Q&A button, and we'll be happy to address. We really like your questions, so any question is very welcome. So number one, looking at following our normal process, let's look at tracking the storm. We've identified that the decline in the market has come in 3 phases so far. Number one is the storm, where we had 4 really miserable weeks in the 10+ range. Followed the recovery phase, a couple of very good weeks, 10.28, 11.47. And now we're in a phase that we're calling uncertainty, where for the past 5 weeks, we've been up or down a little bit, but the market has really trended sideways, mostly over that period. So now we're going to look, today our major focus of our webinar is repositioning our equity portfolios, protecting capital, capitalizing on opportunity, and positioning for growth. Now, first of all, we're going to look at the performance of the equity portfolios and the overall portfolios prior to COVID-19, during the crisis, and then during the recovery from the storm. So if we look at the overall balanced portfolios, you can see moderate conservative. It has been improving through this. We're currently negative 5.6%, balanced at negative 6.5% year to date, and moderate growth in the negative 8 range. That compares to the TSX Composite Index at negative 12 and the S&P 500 year to date at 8.74. So the balanced approach is working in helping to protect capital in this declining market. First, let's look at the performance of the equity portfolio. So we're going to focus really today on the equity portfolio. And you can see the green spot is the Wealth Stewards equity portfolio that's been in place. I call it March 20th, but it's been in place all of last year pretty much. So from January 1st of 2019 to February the 20th of 2020, which is really the day that markets started the decline, we did 23.74%, which ranks us kind of in the middle, a little better than international at 20.85, and a bit behind the S&P 500 at 37%. Then we went into the trough from February 20th to March 23rd, which is really where the decline hit. And you can see that whether you're in the S&P or whether you're international or whether you're in the Wealth Stewards portfolio, that you're in the 32 to 33% range. And then on the recovery so far, we've had a good bounce back. We're in the 24% range, a little bit behind the TSX and the S&P, but we are a more conservative portfolio, so we try to outperform in down markets and try to perform, but we're not trying to. It's not an all-in bet on technology or anything that's going to get us those kind of crazy returns up above. Now, why is this an interesting time to reposition portfolios? We think that the best time to study performance is during the optimism through elation period in the market. So when the market's really performing, we want to see how are we keeping up with the market in good times. And then when the markets decline, that's when we really stress test the portfolio to analyze it, to see, how does this, we've analyzed our clients' portfolios, we have risk assessments and such. And what we really want to do is want to make sure that the portfolio is fulfilling what's going on. Siri seems to want to join me in today's call. So how does the equity reposition fit? And I'm going to turn over to Paul.
Thank you, Bob. I guess one of the things that we always gauge what we do is up against the longer term viewpoint. And you're going to see a lot of changes. It appears like a lot of changes. But these are consistent with our investment philosophy, which we're going to go over a little bit. We often talk about asset allocation being a key element of investing. And today, this is really a reallocation, but within that framework of asset allocation being vitally important. We are maintaining plenty of diversification and still looking for non-correlation or non-connection to other parts of the market. And of course, we are always mindful of taxation. And so where we put certain securities will be ever more important as we go forward, because I think it's pretty evident that there are going to be massive government deficits, and usually the way to pay that back is some pressure, if not in this instance, on taxation levels. Next slide. So the main thing is that we really are maintaining a long-term focus. And we know that, you see the tortoise and the hare, that it is very difficult to be sprinting in one direction and another and ultimately outperform just a steady, disciplined approach and with some patience. So while none of us here, I don't think anybody anywhere, could have anticipated where we are today, it's been a tough time to understand and even deal with emotionally. But our focus is on that we first are focused on capital preservation. And we do that by being mindful of each individual risk tolerance and then making sure that we understand each individual. And so every portfolio is really set up to meet the individuals, but it's within the bigger framework that we're going to talk about right now. Next slide. So there are two components in our investment philosophy, and one is called the core. And the core is the larger part of our portfolios, and it's made up of low-cost securities, which we adjust strategically based on some macro trends, typically. You will see it's a combination of stocks and bonds, real estate, and of course cash, which we have to remember is an important asset class from a liquidity point of view. And then the instruments that we use in our portfolios are on the right-hand side. We have moved more than we ever have towards individual securities. We continue to use exchange-traded funds and low-cost mutual funds. The satellite is made up of some very unique strategies. And the idea of satellite is to have investments that aren't connected or correlated to the core. They tend to be niche investments. And so over the years, currently we would have such niche investments as private debt and some private equity instruments. The intent is that it not only it augments the core, and it tends to reduce volatility. And I can tell you that one of the main reasons why we have seen less downturn than the public markets is because of the satellites that we have in place. Now, we're certainly not the only organizations that do this. In fact, a recent study that was done with some of the major pension funds to see the dramatic move of Ontario Teachers Pension Plan, Canada Pension Plan, OMERS, and so on, towards less public market securities and more in the satellite category. In our case, really important because of the high net worth nature of many of our clients, is we're seeking tax preferred growth. So some of the satellite investments are uniquely put into portfolios from a taxable, or to make sure that we're minimizing tax. So what has changed and why? It seems that if the investment philosophy hasn't changed and performance, while it hasn't been stellar, has been in the pack, why are we repositioning equities in a fairly substantial way? Well, I can tell you that as I sit here, there is more uncertainty, not only than normal, but certainly more uncertainty than I've ever experienced in my lifetime. And an important call I was on at about 7 this morning with some senior portfolio managers was really echoing that point. We've never in our lifetimes seen the level of uncertainty as we look forward. So in light of that, we have taken a very cautious stance. We are from broad indexes to sectors and individual companies that we expect to survive, no question, to get across the abyss. I think it goes without saying these days that many private businesses, for sure, but even some public entities, will not make it across this abyss given the hit to their business model. But what we've done is we have picked certain areas that we believe are going to do that and will do well in the long run. A great example of that would be the real estate sector. In today's Globe and Mail, there was a fairly substantial article about BMO, Bank of Montreal, stating that I believe it was up to 80 workforce they can foresee going forward of having a combination of work at home and the office. I think there's a prime example of a sector within the broader real estate sector that probably will have a very significant change. So our response to that is that we have moved away from that particular area of the real estate sector, and we're taking a much tighter focus on components of the real estate sector that we actually think will benefit as a result of this. And one of those will be people living in apartments. I think increasingly we're going to see people who home is also their office, and we'll probably be putting more into that sector than we saw before. In short, right now, we are staying extremely defensive. And I say for now, we have a lot of cash ready to be deployed if needed. Be a cautious road as we go through some of these changes.
Okay, it's Bob Simpson again. And one of the things that I would just like to apologize. It sounds like we're having a little bit of static on the lines. Hopefully it's not too disruptive, but I want to look now at what we call the recovery portfolios. So Wealth Stewart's recovery portfolios are strategically managed, diversified portfolios of individual equities focused on the strongest stock market sectors, and they're made up of large cap North American companies where you will recognize the name, the fundamentals are strong, they have a long-term track record of generating consistent and predictable earnings growth, and they're trading at reasonable prices. The advantage of using the recovery, and the recovery portfolio is really a new addition to the portfolio. It's taking over from some of the areas that we thought were performing poorly. The advantages of the recovery portfolios is they help you to reduce overall costs. So we're not paying fund managers for this. We're not paying ETF managers. We're doing it, on the basic costs of the portfolio. It helps us to maintain diversification. It holds larger companies with great track records that have historically outperformed the major indices. And you'll hear a lot of talk that people say only 20% of managers ever beat the index. But on the other hand, 50% of the stocks in the index beat the index. So by focusing in on the great companies with the long-term track records that have a history of outperformance and then diversifying, it gives us a better chance of outperformance in the portfolios. And these companies are what we would consider better investment quality, investment grade companies than some that you might get in other portfolios. So let's look at some of the moves that we made already. One of the moves we made was that a couple of years ago, there was a gold position that was put on within the portfolio. That gold position combined with a falling Canadian dollar has resulted in about a 50% increase in the holdings. So we have moved on from there. Not that we don't totally dislike gold, but we felt that with some of the opportunities presented by the coronavirus decline, that we could buy some great companies like Royal Bank and TD Bank that are trading at multi-year low valuations, and they're yielding 5% as a current dividend. So this is a chart on the left of the Royal Bank, and you can see over the past 10 years that Royal Bank on a price to earnings ratio is trading way down at the low end of the range, at a price to book, again, way down at the low end of the range. And that is mirrored over on the right-hand side by the TD Bank showing the same. So we felt that being able to pick up the banks at a 5% yield at very low valuations was a good trade. So we made that shift in the portfolio. Next, DFA International, we made a shift to the US recovery strategy. We moved on from Dimensional Fund Advisors International Equity, which was a large holding there. What we're seeing there is we're seeing world trade contraction. We're going to see more success we believe, in North American markets with some changing demographics and such. The DFA International had a tilt toward value versus growth, small cap versus large cap, and both value and small cap have been underperforming for a reasonable period of time. So we thought that it would be a good time to move on from that. Number one, the sectors are underperforming, and DFA hasn't been living up to its past performance. So we thought it'd be better to move on. So we moved on to the recovery portfolio made up of leading multinational companies. So we still have that international exposure through North American companies that are doing business around the world. Now here's the process that we follow for creating the recovery portfolio. Number one, we took a look. There are 11 sectors in the market. Of the 11 sectors, we really focus in on 7 of them, and I'll discuss that in a second. But we want those sectors that have companies that exhibit consistent and predictable earnings growth and have very, very, very strong balance sheets. So we do a screen using technology to identify those companies. The next thing we look at is we review what the analysts think. So we can see what the history says, but we want to have some view into the future. So we follow the analysts' views to get their idea of earnings growth. We then look at price trends. Price trends sometimes can give you an indication that what we're seeing in the fundamentals are changing and that we should move on. Number 4, we analyze valuations. We don't want to pay a high price. So it's kind of a GARP, growth at a reasonable price approach that we're doing. So if we have a company and the price earnings multiples and the valuations are too high, we'll veer away from those. We're really looking for companies that we believe offer good value at today's prices. We also want to make sure that we're diversified. So we diversify by sector. We're splitting up the sector. We're not overweighting and making a big bet in technology or healthcare. We're being pretty consistently diversified across the board in those 7 areas. And then we monitor very attentively to see what changes are happening. But if we see that the fundamentals and the growth trends remain strong, we stick with them. So here's an example of a really great company over the past few years, Adobe. We're all familiar with that. The blue line is the price. The orange line is the earnings. So you can see as earnings took off with Adobe, primarily when they made the shift from selling programs to selling software as a service. So now instead of paying $500 up front, you pay $35 a month and you pay that ongoing. That's really changed their earnings profile. The chart up in the top right-hand corner, the orange line is the historical earnings. The red line shows the predicted earnings growth for Adobe. And you can see that Adobe's earnings are expected to grow over the next 2 years from $6.60 a share to $12.90 a share. So a doubling in earnings over the next couple of years. And the bottom right corner shows the price earnings multiple, orange line being the 5-year average, the blue line being the price earnings multiple. So you can see that we're trading at 58 times earnings, which is lower than the 5-year average at 63. So this is what we're really looking for. Companies with strong growth, strong predicted growth, and trading at a reasonable price. So let's look at the recovery program. The US side, we focus in on 7 of the sectors. We exclude energy and basic materials, primarily because the way I describe energy and basic materials is they go up and down, but sideways over time. So to be successful investing in those 2 sectors, you really need to be a market timer. We're looking for consistent and predictable. They're very inconsistent and unpredictable. Utilities are essentially bonds, so we already have that covered in our portfolio. And then we treat real estate as a separate strategy. So we focus in on technology companies, healthcare, consumer defensive, consumer cyclical, industrials, financials, and communications. And then we throw in a BMO, sort of to balance the whole thing out. BMO, US low volatility, which has been one of the great performers in the portfolio to date. So we kept that and spread it out. So companies like Microsoft and Adobe and Amgen, you know, companies, Hershey's, Amazon, Home Depot, all companies that you're familiar with. The next thing that we did is we moved the DFA International hedge position. And this is still in the works. The trade hasn't totally taken place yet, but moved out of the DFA International to an actively managed fund managed by David Fingold, Dynamic Global Dividend. He's been a great performer over time. What I really like about, or what we really like about David Fingold and his approach is if you talk to him in every conversation, he will say 3 times, I really hate losing money. So he's much more defensive. And we feel that in this uncertain time, we want an active manager who is there to have our back and to help us protect our capital. Next, we move from the NBC National Bank Canadian to the Canadian Recovery Strategy. The NBC Canadian was primarily, it was just simply the TSX 60 index, which is 35% banks, 20% energy, 15% materials. We wanted to move away from energy and materials. Not to say that they're not going to go up. Not to say they're not going to recover. We just think longer term, we want to be in those better, consistent and predictable companies. So we've moved into the Canadian Recovery Strategy. In this case, because it's harder to find good Canadian companies, we've really just focused in on four of the sectors: Constellation Software, Boyd Group. Boyd Group has returned to shareholders prior to this decline. I just haven't looked at the numbers recently, but they've returned to shareholders 10 or 50% a year for the last 10 years. So probably now in the 45% range. Constellation Software is in the 40% return for the last 10-year category. So we really like those. Canadian National Railway, Royal Bank, and TD that we discussed. And then we balance that out with the Bank of Montreal, the BMO Canadian Low Volatility ETF, which holds more of this type of company. We are also in the midst of a trade where we are moving out of the iShares TSX capped real estate investment trust into the CI Signature Real Estate Trust. Last week, 2 weeks ago, we had Kate McDonald, the portfolio manager, one of the portfolio managers for CI Signature, who managed that. Major shift there is that when you buy a broad-based ETF, they invest in everything. There's no selection. You know, we want to stay away from some of the weak areas as we come out of this, as we're in this recovery. We want to stay away from office buildings. We want to stay away from shopping malls. We like the idea of apartment buildings, as Paul mentioned. There are 88 million millennials between the age of 35 and 15 who are all going to be renting for the next 20 years. So apartment buildings we like, and one of the things we look at is demographics when we make such a decision. So what does the portfolio look like right now? We've taken the US recovery and we've invested part of it. So we've invested 25 of 35%. We're currently holding 10% of that in cash, 10 of 35. On the Canadian recovery, we're building the portfolio to a 20% holding. We're holding back 5% in cash right now. So we've got 15% in cash, just in case we get a second down wave in the market, and to protect capital during a period of uncertainty. We've got the Dynamic Global that we talked about, David Fingold. We're continue to hold a Pender small cap fund just to give us some exposure there. DFA US core has performed really well, so we're maintaining that position going forward. And then we're splitting up our previous exposure to real estate into signature and into some of the private opportunities that have presented themselves over the past couple of years. So that's a bit of a recap. Paul, do you have any other thoughts that you want to share before we move to the Q&A session?
No, in the interest of time, I think, Bob, you did a great job sort of covering off the highlights.
Okay, so if anybody has any questions, as we showed in the slide, there is a Q&A button. If you have a question, just click in there and don't be shy. You know, no question is a bad question. And just type in your question. We'll be glad to answer it. We do have one question that during the past week, an existing client sent in. So I'm going to read this question and pass it on to Paul. The question is, at what point does Wealth Stewards turn its attention to the US election? How will the proposed policies of the potential candidates with respect to corporate individual taxes and deficit control affect the management of the portfolio? Paul, do you want to take that?
Well, does everybody have 24 hours to discuss this one? Let's face it, we are dealing with an extremely high level of uncertainty with COVID and the impact on the investment markets, business more broadly in the economy. When we start to turn our mind to the election, to me, that's just a whole other level of uncertainty that we have. However, so because none of us knows the future, what we really have to do is stay on top of things as they become clearer, more evident, and just see if we can identify particular trends and implications that we can act on it. So I can tell you at this point in time, this is not a front and center issue. I think for many of us, we would normally have expected the Republicans not to be spending as much money as the Democrats. And yet here we are with record spending, record deficits in response to a big uncertainty. And it was interesting that this is one of the rare times of late that we've actually seen some agreement in actually bringing out a rescue package and so on. That doesn't mean they're all buddies by any means. So it's a big question. It's one of the big uncertainties. We get lots of research on a regular basis, and we will be monitoring that to see if we can divine information on that score, as well as in other uncertainties as they might affect markets broadly and our portfolios in particular. I know that's not a decisive answer, but the reality is this is one of so many uncertainties at the moment. Quite frankly, it's one of the reasons why we have the level of cash that we do and have really started to tighten the focus of our portfolios is because of the level of uncertainty. And while we may have some cash drag for a while, in the interest of protecting the downside, which is our number one issue, what most clients look for, we are going to maintain that cash position until we have some clarity.
Okay. Second question for you, Paul, is that, you know, we've had a bit of a rocky ride since February 20th, where the market bottomed out on the 23rd of March, and then it's recovered from there. Why is this a good time to do the changes in the portfolio as opposed to, let's say, a month ago, you know, when prices were rock bottom?
Well, we touched on that a little bit earlier, but when there is panic, it is very difficult to know if you're even close to a bottom. I can assure everybody in this call that we were watching this, if not 24/7, pretty darn close to it. But the reality is we could see some things coming up that look pretty good. The first trade that we made was selling our gold position and moving into the two major Canadian banks. As it turned out, gold continued on for a little bit and then it started to pull back. But pulling the trigger at every step, even though we've identified some of the changes that we've identified the changes that we want to make, but we have sort of only gingerly and methodically gone in and actually executed some of the changes. So some of you would look at your portfolio today and you wouldn't see all of the changes made that have been reflected in this presentation. And that's because in some cases we've only implemented half of what we would like to get to. We're just being we're holding back a little bit, as we mentioned about cash. But let's face it, COVID has created like real estate, that there are going to be some things that quite assuredly we are not going to come out of this looking the same as we went into it.
Okay, next question for you, Paul, is there a way of adjusting strategies to account for the fact that in the years to come, governments will need to take steps to reduce debt and the deficit?
Well, I read an extensive piece, I think it was 2 days ago, and it was really on governments, how they often deal with massive deficits or massive debt is to try to inflate their way out of it. And, there clearly are pros and cons. If inflation increases, generally speaking, what you do is you choose assets that are going to be at least not swimming downstream with the inflation, certainly are accommodating that inflationary change. So I don't think there's any doubt that we are going to see massive deficits. There is a view with some of the economists that this can carry on ad infinitum, that governments really don't have to worry about paying debts back. There's a view that you can continue to print money. There have been times in history over the long run where that view has been propagated and it's come to a very untimely end. So, and not only untimely, but a very negative consequence. So I think we have to watch that carefully and just see if there's a move afoot to actually try to inflate their way out of it and just to respond accordingly. But right now, I think the governments are also in crisis mode, and they have no playbook how to deal with this. And so at the moment, it seems that they're responding with just opening the floodgates and then sort of picking up the pieces later. I believe, as an accountant, that one of the unfortunate things is we are going to see a focus on taxation like never before. Vern Vippel, who is part of our team, he was a tax partner with KPMG Law in the past, and he was giving me some stats recently how CRA's focus in hiring additional tax people has sort of a 9-to-1 return on the money that's being spent. I foresee this continuing, and looking for more areas to collect tax dollars than ever.
Okay, well, thank you very much for the questions today. And just for the sake of time, we'll let you all go to enjoy the beautiful weather that we're experiencing. Our next session will be on June the 5th, 2 weeks from today. We did have a request from a participant to have somebody come and address small business and how small business is dealing with the COVID-19 and what some companies are doing to really come out of this bigger and stronger and better by making adjustments. So we have a speaker from Canadian Federation of Independent Business who will be joining us in 2 weeks on the storm. So thanks very much for everybody for coming out today. We appreciate your time and participation, and we look forward to seeing you all. I see there is a little button up on the thing. Somebody say great session, thank you, and we'll thank you very much for that. Appreciate it. So we'll catch you all in a couple weeks. Hope you enjoyed today's talk and found it very useful.
Thank you, Bob.
Okay, bye.